certainly sounds really bad. Is it as bad as
we
it
talked
sounds?
about this. You know, John Ehrlichman, the great John Ehrlichman, broke the news of the secondary offering. And it was shocking news because of who was selling and who wasn't. Now, we always show you the stock chart when we start to drill down. It is the company news behind a stock on the move. But pay attention to the Zynga stock chart. When you think about what happened to this company when they went public at about $10 a share. The stock went up. Back there in March and April of 2012, Mark Pincus and a select few members of the company were able to dump a lot of shares on the market. And that was the result of them taking away the lockup. They promised to not sell shares until the end of May of that year, but they changed that. They did a secondary offering. In the secondary offering, they said this: we are releasing the selling stockholders from those lockups, the lockups that were agreed to permit them to sell up to 49,414,526 shares. But that wasn't for everyone.
So who were the people who sold other than Mark Pincus?
So it was Mark Pincus, and that's really important. So they were the executives, the people who knew what was going on behind the doors of this company, the insiders. CEO Mark Pincus, COO John Shapard, a former exec and board member Owen Van Natta, as well as some other board members. But those three guys were big sellers, and we're talking about a lot of money here. Mark Pincus alone sold $192 million in stock back in March of 2012 in that secondary offering. Shapard sold $4 million. Van Natta sold $6 million. So you had these guys who knew what was going on inside the business, selling shares while preventing other shareholders from selling.
So the other employees were required to wait another month through the quarter's results. And how big a deal was that? Because that was a very critical set of results.
Sure, and the stock sold off after those results came out. And it's worth noting that this Wendy Lee waited well after that to sell her shares. She ended up selling her shares for less than she paid for them. So she went to work for Zynga for whatever her salary was in stock options. She exercised those stock options at just under $4 a share. She had to sell those shares for just over $3 a share. But the float is really important here. Mark Zynga and the other sellers were able to take advantage of a very reduced float. There was high demand for a small amount of Zynga shares. There was just 79 million shares available at the end of the year before the secondary. After the secondary, there were 198 million shares out there. So not only had the price come down a lot because the information was getting bad, the results were crummy. The insiders knew that as the results were going on. I'm not saying they had non-public inside information, but they knew how the business was working. But also the amount of shares out there, by letting so many more shares out there, the available float was so much bigger, the supply was bigger, the demand was less, the stock came down. That hurt.